Joining. My name's Tom Lowe. I'm going to start with a story, and then we'll get into the heart of the presentation. The reason you guys are here, talk about Meta. So I want to take you back to the late 90s. And I remember it very clearly. I was sitting in my cube. I could hear the sound of champagne corks popping, people high-fiving each other, and we were all very happy because I was at a tech startup. We had just had our IPO. So people were happy that day. And then the next months following, people got happier and happier as the stock kept going up. And so I thought to myself at a certain point, if this keeps happening, I'm going to be able to get to financial independence in my late 20s. So I was feeling pretty good about that. But then those of you who know history know that the dot-com bubble burst. I was the dot-com, and I held on to all of my stock until the company shut down. And so an important thing came out of that, and that was that I realized, hey, I need to educate myself about how my equity works because it's an important part of my comp here in Silicon Valley. And that education led me to making a career change into financial planning, is why I'm here today. In fact, the reason I built this firm is because I want to make sure that people like you at Meta who are working hard for their equity are able to make the most of it, and they don't end up in a place where they don't get anything out of it. So that's why we're here today. That's what we're here to talk about. So let me start by sharing some slides with you. So hopefully you're all here, Meta employees, and you want to understand how can you get to financial independence with your RSUs. So this information is for educational purposes. You should always talk to your professional, your advisor. So here's a quick agenda of what we're going to cover. So told you a bit about my background, why I do this. I'm going to take you through 3 steps to help you understand how you can get to financial independence. So step 1 is we're going to determine if you have too much in your Meta RSUs. Okay. Step 2 would be we'll figure out, okay, how do you identify, quantify your financial goals, your assets, your liabilities to help you understand can you get to financial independence. Step 3, decide on where and how much you should sell of your Meta RSUs. And then at the end, we'll talk about next steps. We'll have some live Q&A. So any questions you have for me, as we're going through, feel free to drop in the chat and we'll answer those at that time. Now, I've done a number of these webinars. I find some people are happy to ask their questions during Q&A, but if you want a more private setting and you want the chance for everybody who's attending the webinar today, I'm offering a free financial independence with Meta RSUs game plan. So we can talk through what's your situation, talk about your RSUs, talk about your goals, and get a sense of, okay, here's the game plan for getting to financial independence. Okay, so if you want to do that, then again, or you want to ask any questions, I'm going to drop right now. There's a button, which is a schedule now button. You click on that, you just put time in my calendar, and you can schedule no cost, no obligation consultation. You get a free personalized financial independence with Meta RSUs game plan. Okay, or if you just have questions about your Meta RSUs that you want to talk through, then I'm happy to do that. If for some reason there are limited times you can't book a time that's reasonable, then feel free to email me. I'll give you my email address. It's tom@vestedfinancialplanning.com. Okay. All right. So let's get started here. This I expect will take about 20, 25 minutes, and then we'll have time, a few minutes for the live Q&A. All right. So I talked to you about my background and as I said, I specialize, I only work with big tech professionals like Meta employees, and that's why I'm here today. So let's start with step one, determine if you have too much in your Meta RSU. So this is where I'd like to start because clients come to me, most of them at places like Meta, and I start by talking about this concept of concentrated stock. And this is when you own too much of a single company stock. And my general guideline is 20% or more of your investable assets is probably too much. And that's because when you look at it versus a diversified portfolio, there's just a ton more volatility, ton more risk. Okay. And the example that really captures this is Silicon Valley Bank. So this is fairly recent. You guys may or may not be aware of it happening, which is here's the stock chart starting the 90s up and to the right, up above $600 a share. And then some bad stuff happened. The bank failed and shareholders lost everything. So I have a good friend who's a financial planner who worked with someone at Silicon Valley Bank. He was about to retire. He had $7 million, all of it in Silicon Valley Bank. And then within weeks, he had nothing. Okay. So that is the real risk of being too highly concentrated in a single company stock. Something bad that happens beyond your control could take away a lot of your net worth very quickly. Okay. So first question for you guys is, hey, how do I know if I have too much in my Meta RSUs? So I'm going to walk you through the steps. I'll give you a quick example. You can then try to understand, okay, do you have too much? So step one is simply just calculate the total value of your vested Meta RSUs. Just multiply your number of RSUs by the current stock price. Simple. Step two is calculate the total value of your investable assets. So that's any savings, investment accounts, retirement accounts, 401k, and then take that, add it to the total value of vested Meta RSUs. Step three, simply divide the value of your vested Meta RSUs by the total value of your investable assets. You get some percentage of concentration. And if your concentration is more than 20%, then you're highly concentrated and you want to think about diversifying. So this is kind of where I would like to start Meta employees because often they're highly concentrated. So quick example is, let's say you got 1,000 vested RSUs, say it's $500 a share, that's 500,000 of vested Meta RSUs. And then let's say you add up everything else. So your savings, investments, retirement accounts, 401ks, that's 500,000. Then you take your 500,000 of Meta RSUs plus the other 500,000, you got $1 million of total investable assets. You divide your 500,000 of Meta by $1 million total, your 50% concentration. 50% is more than 20%. So you're highly concentrated. You ought to think about doing this. And just for context, most of my clients come to me with pretty high concentration. So it's common for people to come with 50, 70, 95% concentration in a single company stock. So if you're there, you want to be aware of it and you want to figure out, okay, what can we do about it? Okay, so step two is you want to identify, quantify your financial goals, your assets, your liabilities, and this is going to help you understand how do you get to financial independence, okay, along with using your Meta RSUs. So we would start with identifying your financial goals. So few examples of goals would be, hey, when is it you want to get to financial independence? Do you want to buy a house? Do you want to pay for college for the kids? Do you want to make sure you have the travel budget? You want to cover your ongoing living expenses, okay? Then, importantly, you want to take those goals and you want to quantify them, okay? So as an example, you say you want to buy a house. All right, well, let's buy a $2 million, how much? $2 million house. You're going to need $400,000 for a 20% down payment, and then you're going to have the rest on a 30-year fixed mortgage, okay? So for each of your goals, we want to quantify. And the next step is we want to collect your assets, your liabilities, all of that data. So assets would be things like your RSUs, any other employee equity, investments, retirement, savings, any real estate you may have. And then liabilities, common examples would be your mortgage. Okay, have that. Okay, next step would be either make assumptions or you want to adjust if you're using planning software, the assumptions there. And those are key things like, okay, what's your income now, savings rate, how much equity, what's your vesting schedule, expenses, your how are you investing? And I recommend you use financial planning software. It's built to make it simple. And if you want to do it on your own, there's software makers out there like Bolden or MaxIFi. You can do it yourself. If you want to, and you're comfortable with Excel, you just build it in Excel. But software is much easier. They've already figured all that out, but you can use Excel if you want. And alternatively, if you don't want to do it yourself, you can get help from a financial planner like me, and they use software. I'll give you, and Right Capital is the software I use right now, and I with clients. So let me take a moment. I want to give you a couple minutes to screen share, give you an idea what this looks like when I talk about financial planning software. Okay, so I am sharing with you. Okay, so just did a quick example. I'm going to run you through this just so you understand what this looks like. So this is a family, John and Jane Smith, both in their late 30s, 2 kids, Billy and Susie. So we said, okay, what are the goals? So goals are retire at 50, expenses, college for both kids, buy a house, travel budget, charitable giving. So for example, we have the goals, we want to quantify them. So in this case, we say there's a house we want to buy, $2 million in California in 2027, property tax, insurance, maintenance, 20% down, 30 years fixed. Okay, so we've quantified that goal. And then we have the net worth, which is the various investments, etc. So in this case, we said they both work at Meta, so they have RSUs, they have a 401, they both have 401ks. And then we talk about those assumptions like here's the income, here's how much they're saving at, here are expenses. And then we put this through the software. We run what's called a Monte Carlo simulation, and that's like 1,000 different scenarios, different market conditions to understand, okay, what is the probability of success of reaching all of these goals given this assumption? So in this case, we're targeting, usually we want them between 80 to 100%. These guys are at 92%, so right where we want them. And then we have this gives us a baseline scenario to understand, okay, if they can get to financial independence at age 50, given these conditions. But let's say they said, okay, what if we wanted to retire at 45? What does that do to our probability of success? Okay. And remember, we're targeting between 80 and 100. Drops you out of the target range, but then you say, okay, well, what can I do if I still want to retire at 45? Well, for example, you can reduce your expenses. Let's say you go from 15 to 10. That's a key lever to pull. Can that increase your probability of success? Back to the target range, which it does. So we have a baseline scenario, and then you can figure out, okay, what trade-offs do we want to make if we want to try to do different things? All right, so that's just a quick example of when I talk about planning software, that's what it looks like. So let me go back to the slides. Okay. Okay. Okay, so again, planning software, there's financial planning software you can do on your own, or again, work with a planner like me, and that's the kind of exercise we can do. Now, some of you may be saying, well, that seems like a lot of work. or too much time. So a way to get a very simplified ballpark idea of if you're close to financial independence. I don't recommend this because it's not personalized at all, dependent on your specific goals and situation. But this is called the 4% rule. Gives you at least an idea. And so what the 4% rule says, you can take 4% per year, probably 3 to 4% is the right number of your portfolio value. And then if you can, and that can last for your portfolio can last for a few decades, as long as that's enough to cover your expenses. So for example, if you have $1 million portfolio, you can probably draw 30 to 40,000 a year out of that. So for example, let's say you had a $10 million portfolio, that means you can draw 300 to 400,000 a year out of it. If that's enough to cover your living expenses, then you have reached financial independence. Okay. Very simplified way. If you want to at least get a ballpark idea, planning software is the way I recommend you get a much more precise, personalized idea. So once you understand when you can reach financial independence, then as I said in the quick example, Right Capital, you can just run different scenarios to understand, okay, what are the trade-offs you can make? So if you figure out I can get to financial independence at 50 and you're happy with that, that's great. But you can also understand, well, if I want to get there by 45, what are the trade-offs I need to make? And it probably is something like, I either need to earn more, I need to reduce my expenses, I need to modify my goals. But doing those things may enable you to get to financial independence earlier. Or you may say, hey, I'm comfortable. I think I'm going to go to my mid 50s or 60. If you do that, then that means you can potentially spend more. You can increase or add goals. But it's a way to help you think about, to understand when you can get to financial independence, and then the trade-offs you need to make if you want to make changes to that. Okay. So step 3 is, once you got your plan in place, you want to decide on when and how much you should sell of your Meta RSUs. Okay. So for example, if you said I need 5 million to reach financial independence based on the plan, and you have 10 million of Meta RSUs, what I would suggest is sell enough to get you to your financial independence, and then you can choose what to do, but you don't have to sell the rest of your Meta RSUs. But this at least gives you a way for deciding how much to sell. Now, for most of my clients, they're not ready to immediately get to financial independence. Then I suggest you follow the steps below. So first thing is, all right, let's sell immediately to cover any valid near-term cash needs. And that means things you know you're going to have to pay in the near term being, the next 6 months to a year. So for example, if you know you need to pay your taxes on your vesting of your Meta RSUs and you don't have it set aside in cash, then I suggest sell your RSUs, get your cash, make sure you can pay your taxes. Okay. Another example would be, I don't want to buy a house in the next 6 months to a year, and you need, say, $400,000. Go ahead and sell your Meta RSUs, because what you don't want to happen is say, okay, I have my down payment, it's in the form of my Meta RSUs, and then the next round of tariffs is announced and your stock drops 20%. So now you have to sell more RSUs to get your down payment, or you don't have your down payment. Okay. So that's the first step. The next step is decide if you want to keep a certain percentage. So most of my clients say, hey, I believe in the long-term future of the company. I want to keep some. So decide what percentage you want to keep. I'd recommend something like 5 to 10% at most, but you need to decide what you're comfortable with. For some, it may be 20%, 40%, 50%, but you need to figure out what you're comfortable with. And you can say, okay, I'm going to take that percentage, I'm going to set it aside. And then you take your remaining Meta RSUs and you have a few different ways you can approach this. Okay, one is you can just sell them immediately. Okay, so next window's open, you sell everything. It's simple. You don't have to worry about the stock going up or down, and you have your cash. Okay, and then two other versions. Most of my clients don't like that version. A couple other ways to think about it are you can sell over time on a schedule. And then there's another flavor of that. So let me explain what that means. You could just say, what I'm going to do is I'm going to sell 25% a quarter over the next 4 quarters. I'm going to sell 10% a quarter over the next 10 quarters. Okay. When the window opens, you sell that percentage. You don't, and there are a couple of benefits. One is you don't have to worry about all the emotion around, hey, is the price high enough? Or, hey, I think it's going to go down. Or you don't have to do any of that. When window opens, you have your percentage and you sell it. Okay. So it's putting it on autopilot. It's minimizing your emotion. The other benefit is you spread your taxes over multiple years. Okay. And then the other version is sell on a schedule, but more when the price is higher, less when it's lower. So what you can do is say, I'm going to set price bands. So if it's less than 500, I'm going to sell 25%. If it is between 500 and 600, I'm going to sell 33%. If it is above 600, I'm going to sell 50%. So every quarter, you get to the quarter, window opens, you look where the price is, wherever it fits in the band. Let's say it's 450, then you sell 25%. Next quarter, it is 550, you sell 33%, and so on. Again, it's on autopilot. You're trying to minimize your emotion. You get to spread your taxes out. But some people feel better because you're selling more when it's higher, less when it's lower. Okay. So these are ways of thinking about how much and when you should sell your RSUs. And then once you get that cash, that is going to help you then build towards reaching financial independence. Okay. All right. So before we get into the Q&A, I want to take a minute and tell you what I call the happy path story, just to give you a sense of the opportunity that you guys have because you're working at a place like Meta. So I had a client come to me, big tech company. They had a lot of equity, and they said, hey, help us understand what to do with this equity. So we put together a plan and we identified a few important goals. They wanted to buy a house. They had a couple of kids, so they wanted to save for college. They also wanted to get to financial independence early. So we put together a plan. We then put together a selling plan. They were able to diversify out of their big tech employee stock, RSUs, minimize taxes. They bought the house they wanted. They put aside funds to save for college. The kids are good for college. And now they have they are on track to get to financial independence early at an early age. So this is the opportunity you have because you're at Meta. You have the RSUs and the equity that's going to enable you to get to your financial goals much faster than a person working at a normal company in the rest of the world. Okay, so that's what we want to do ideally. Okay, so again, feel free to click on the button. You guys want to get a free, hey, how do I get financial independence with my RSUs game plan? Then feel free to put time on my calendar, clicking on the schedule now button. And here's my email address if you have any questions. So let's take a moment for live Q&A. Take a few minutes here. So let me check the chat here. Okay. Saruba's question is, can you share your recommendation on selling RSUs versus taking a margin loan against RSUs for near-term cash needs, down payment? Thank you. Okay. So the question is, all right, what do you think of selling RSUs versus you could take a margin loan against your RSUs for near-term cash needs down payment? Okay. In general, I would recommend just selling your RSUs so that you know you have your cash. Okay. The margin loan, the risk is if there's a big drop in the stock, then you will be forced to sell the stock, even if you didn't want to, but at a much lower price. Okay. So that's why I'd recommend getting the cash. Then you don't have to worry about that risk. The other thing to keep in mind is if it's simply a bridge loan, meaning I only need this for a short period of time, and you don't want to sell your RSUs because you have to pay a bunch of taxes, you can use something like a margin loan, or there's something called a securities-based line of credit, SBLOC. If you know it's for a very short window, like we need 30 days before we get the cash, then that would be something to consider, but still you have the same risk that you want to think about. Okay. Okay, good question. Any other questions about your RSUs or your getting to financial independence? Any questions, feel free to drop them into the chat. Okay. All right. I'm not seeing any other questions at the moment. So again, if you have questions, but you don't want to ask in the chat, feel free to put time on the calendar. We can talk about those, or okay, or email me. So another question here from Abhinav. Any recommendations for non-tech heavy ETFs? Okay. So looking for recommendations for non-tech heavy ETFs. So in general, for my philosophy is that markets are generally efficient, which means that I don't think it makes sense for most people to try to pick individual stocks. So if you think about investing in ETFs, in general, I'd look for broadly diversified ETFs, low-cost ETFs, okay? And then as for non-tech heavy ETFs, you can look at, there may be ETFs specifically with that target, but I don't know any off the top of my head. But you could, for example, look at ETFs that focus on US value stocks, because value stocks tend to be non-tech versus growth stocks are stocks like Meta, Apple, Google. Okay, so that's something. You may look at a broadly diversified value ETF that could get you that. I don't know if they have specific non-tech, but you'd want it broadly diversified anyway. Okay. Okay, everybody, since it's 11:30, I want to respect your time. If everyone is going to get a recording, everyone who's registered will get a recording of this. So you can look for that. You should get that sometime today. And if you feel like it was helpful for you, feel free to share it with other coworkers at Meta. And again, put time on my calendar if you want to talk, or email me. Thank you, everybody, for taking the time to join the webinar.